I'm Chris Versace, Chief Investment Officer at Tematica Research, and each week on our Cocktail Investing podcast, we look to break down all the noise you hear each and every week into clear investing signals. Here's an example of what we talked about on this week's podcast. Along with that, and that heightened concern, it was interesting to note that CNN's Fear and Greed Index ticked down from greed to neutral, always watching that. And there's some other data coming out that I noticed that ETF investors, which are accounting for a larger and larger portion of the market, are moving into cash or cash equivalents. And there were these two products in particular that have been, growing and really gaining assets more lately than previously, but really growing. And I want to kind of get your take on them. The two of them they're right in your wheelhouse. This is why I say that, because we know I'm the equity guy, hate bonds. You're the bond chick. So these are what are called ultra short dated bond funds. And there's two of them. One is from PIMCO. It's the Enhanced Short Maturity Active ETF, known interestingly enough as Mint. And then the other one is iShares Short Maturity Bond ETF, ticker symbol NEAR, NEAR. So, I understand what they are. They're investing in ultra short-term U.S. dollar-denominated bonds, looking to kind of give people a hedge in the short term. But as you step back, what do you make of these, Lenore?
Well, I think people are just reacting rationally to seeing that this market is on a historical basis. It's very expensive. And we're seeing more and more questions come up on whether the assumptions that led into that increase in PE ratios, the assumptions that said, well, it makes sense for stock prices to go up so much, those assumptions are being questioned. The tax reform is every month keeps going by, and tax reform not happening.
Well,
and tax reform needed to happen after the healthcare reform, and that's not happening so far. I mean, we'd love to see some movement here, but so far not happening.
I think you coined it very well. I think you did a hit on Fox, and you might have had a little help, but I think you said it was something, the Trump bump is becoming the Trump slump.
Trump slump. Which, and we've been saying that all along, that
right.
the assumptions around how quickly things were going to be able to get done were very aggressive relative to what pretty much any other president is able to get done in a short period of time. Reagan, who was known to be the great communicator and was known to be fantastic for reaching across the aisle, and was working with a group of Democrats that were much more amenable to reaching across the aisle. It took 5 years.
Yeah.
Right. And now we're dealing with a DC that is nowhere near that.
It's fractured. I mean, these guys aren't even around on the weekends, right? Yeah. They take off, they campaign, they do what they do. They're not sitting around, not lounging.
Well, they're not hanging out with each other.
Right. And well, they're not having informal conversations, getting business done. Instead, they're too worried about what's going on Twitter.
Right. So if it was tough for Reagan with those kind of relationships to get this done, it took 5 years, right? How can we reasonably expect that with a DC that is much, much more contentious than we've ever seen, that how is it going to get done that much faster? So we didn't think it was realistic, and it's proving out to not be realistic. But just how unrealistic is what the market's still trying to figure out.
So I hear all that, and I'm tempted to call you Debbie Downer, but I'm afraid you're more like Rhonda Realist. Thanks for listening, and you can find far more on TematicaResearch.com or simply subscribe to the podcast on iTunes.
Found myself an empty row. Thought the show was just all right. Same old Saturday night. Then I made the usual stop. Coffee at the coffee shop. Friendly face nowhere inside. Same old Saturday night. I really thought the papers I bought would help me forget you forever.